It's the losses and the mistakes that we make that essentially make us who we need to become.
What do you think caused this growth mindset?
I actually turned 15 on Mount Everest. And I mean, there was a day I remember clearly. I thought, this is the end of me. I made the mindset that I'm not coming back without making it.
Higgo Van Biljon,
CEO and founder of FinMeUp, has been creating startups since he finished high school.
Now with a degree in accounting,
he has been dealing with the financials of over 5,000 people and has crucial insight into helping individuals gain financial victory.
How would you define or differentiate saving and investing?
Let's say you want to become wealthy. There's two ways you become wealthy. The first side and the first step is the first step. The second part of growing wealth is to
Emergencies happen. So how do you deal with that without compromising your long-term goals?
So there's a third part of building wealth. The third part, which we don't really ever speak about, is
Higgo, learning about where people come from helps me understand who they are. So how would you describe your early childhood growing up?
Yeah, so I'm the youngest of four by quite some mile, and I've always loved sports. So when I was in primary school, most of them were end of schooling or entering university. So for most of my childhood, I was a single child, even though we're four siblings. So that sparked a lot of creativity, because I had to play cricket against myself, play rugby against myself, and I'd always just imagine like I'm the youngest guy ever playing for the Proteas, and how I'm batting with some of my friends playing with me in the Proteas, imagining how I'm batting with AB de Villiers, tackling furniture, all of that. So I definitely think a big part of creativity came from that. I also think, there's always been challenges. I think there's challenges for everyone. And we don't need to, that's a story for another day, but various challenges that I had to face and overcame them, which made me stronger. And also I think I've always had a big passion for money, but not like money, just making money more. So everything actually started in grade 6 when I told my dad I want to buy a gold coin. He's like, why don't you do that? And I said, I want to put my money that I've saved somewhere where it's going to be more in 20 years' time. And that's when he said, look at the stock market. And I fell in love with the stock market. Then throughout school, I fell in love with the concept of business, mixing business with investing. And yeah, so there's so many things that built up to me really enjoying the entrepreneurship space. But feel free to ask deeper questions.
You spoke about those challenges. What did those challenges teach you? And what did you take from them?
Yeah.
And move forward with?
Yeah, so there's various challenges. There's the challenges of rejection, where maybe you wanted to be friends with someone and they not want to be friends with you, or that's part of rejection. Another part of rejection is when you think you're going to make the provincial side and you thought 100% you're going to make it and you didn't make it. That's rejection. So there's been a lot of, let's call it rejection. And if I connect that to business, when I was trying to raise funds, so many venture capitalists or investors just say no because everybody has a good reason, but that's part of rejection. And then the ability to keep going because you've already dealt with let's call it rejection in some form or shape. That's the one thing. Another thing is when I was grade 9, I actually turned 15 on Mount Everest or in the Himalayas. So I climbed Mount Everest base camp then, and I was still very small, very immature and naive, and we were obviously surrounded with incredible people, and there's a few days where you really struggle. And there was a day I remember clearly. I thought, this is the end of me. It was on a climatizing day, so you go up very high, very fast, no oxygen, get back down, and just the thoughts that you have to process then, and the challenges you have to overcome then. Also, I think it just contributes to perseverance. There's if you compare victory versus losses, obviously you learn out of victory, and victory is nice, but it's the losses and the mistakes that we make that essentially make us who we need to become in the future. And I think those various challenges, there's various parts of challenges. I mean, we can talk for many hours of each other's challenges, but those are the things that shape us. And I really believe there's some things put into our lives that we need to overcome to get us to where we need to be. And for me, that was just some of the examples.
It also seems that you've developed this growth mindset early on, and actually using these challenges to grow from it, as opposed to being a victim of your environment. So what do you think caused this growth mindset? Was it family, other people, surrounding yourself with guidance from mentors?
Yeah, it's a mix. It's a combination of so many things. The one thing is definitely family. My older siblings, my parents, my parents worked really hard. My dad would go to work at 5 a.m, come back at 6. He'd never put his stress onto our family or anything like that. So, definitely a lot from parents, a lot from siblings, a lot from mentors especially as well, and a lot from just making a conscious mindset shift on various things in our life, to realize it yourself, because at the end of the day, mentors and people can tell you so many things, and they do, but if you don't practically make it part of your life, it doesn't mean anything. It's that decision making repeatedly that something gets brought into your everyday life where you can actually make the decision you need to make. So when something doesn't go as planned, to be able to consciously decide, okay, well, this is what I'm doing about it, because there's always something that can be done to a situation.
And going back to that Everest story, you said that you thought that could be the end of you. What was going through your mind in that specific scenario, and what pushed you through to get through it? What helped you get through it?
No. One thing, I've got very little left of it, and that is naivety. So the one thing is naivety. I don't even know. My dad saw it in the newspaper, and he's like, he wants to do this. I'm like, well, I want to do it as well. And then we just did it. We didn't even know, what it really entails. So the one thing was naivety, not knowing the challenges that lie ahead, and I think there's beauty in that. The second thing was, before I went, it's probably irresponsible, but I made the mindset that I'm not coming back without making it. There's giving up wasn't even an option. It was probably a bit of something I've been humbled as well a lot in my startup journey, and learned a lot about is pride. It was probably a bit of pride, that I said, well, I'm not a quitter. I'm definitely going to make this. But fortunately it got me through, but it was also pretty responsible. But it was definitely, just giving up wasn't an option. And also just, I don't know, just seeing the end goal and nothing, I think it's like many things in life, when there's a clear end goal, it's much easier to reach it, because obviously there's going to be distractions and thoughts and all of that, but it got me through.
Yeah, that's a good point you made about clarity. I think something that kills the dreams of entrepreneurs is a lack of clarity and not knowing what that end goal is. So I'm glad that you had that clarity to know this is where I'm going, and this is actually where I want to get back to, essentially.
No, it was incredible.
And fast forwarding a bit, you actually co-founded Happy Hour SA, or as you mentioned to me, also invested into Happy Hour SA, as well as Handel. So what did those experiences teach you, early stage entrepreneurial journey?
My entrepreneurship journey definitely didn't start with FinMeUp. In high school, I used to sell biltong and droewors, and that's where I actually learned some tricks on scaling, because I started off selling the biltong, B2C directly to friends. But then I saw, well, a school of 1,500 boys, there's 3, residents or hostels. If I can just get the best salesman in each of the residences and they can sell it for me, I have to do less work. So I partnered with one in each, and they bought at bulk for me at a discount, sold it in their residence. I'm like, okay, well, this works. Until I got shot down by the Snoopy. But anyway, so it was that. It was a bit of music, learning that from the business, the marketing side. I tried to do so many other things. In grade 10, my brother and I wanted to start something called Bumsy, which would have been basically 60-60, but only for baby stuff. So if you need diapers on demand, if you need milk on demand, you order it, the scooter would come with everything. And that was before Uber Eats. But I didn't have the knowledge, we didn't have the technological knowledge or knowledge about raising funds or anything to do it. But we tried. We tried Handel, which was a peer-to-peer rental, also a bit of B2B. But we stopped that because we needed to focus on one venture each, because he had a venture, my venture was FinMeUp, so we had to pause that. Happy I was one of them, but I was more investor, not really a co-founder, which also practically failed. It's still there, but it hasn't succeeded. Started another thing called Glaze, where it's like a marketplace for startups. For if you want a service, you search a service and a startup would appear. Failed. So there was a lot of failures. And FinMeUp was the first thing that really took off. But for me, it was, I'm not stopping with FinMeUp until it is successful. Like, nothing would stop me. So I self-funded the business for about 20 months from all the money I've made through various hustles. And, it wasn't just giving up wasn't an option. So after rejection with investors, I just keep going, continuous, like funding it, joined accelerators. I tried so many things just to raise funding. And when the funding finally came, I could start scaling the business. But even in the search of raising funds, I was already starting to build the community, already paid for designs myself, all of that. So, it's been a massive build up to this. Even post FinMeUp, looked at, invested in a few startups, and even tried dabbling in a few myself, helping my wife grow her business. So there's been a lot of business. Most failed. And I'm glad it did, because I learned a lot of lessons, and some are still running, and FinMeUp being the main one.
Before we get into FinMeUp, what could you say were like the top 3 lessons from all those failures that you've learned?
Sure. Only asking for 3 is a lot. The one thing is definitely, and I think Elon Musk also spoke about it, is wishful thinking. It's very easy to think that when you've got an idea, or because you think it's cool, that other people will also think it's cool, without really validating it first, just going out, not doing the proper research, and just build it. That's what I did with FinMeUp. I didn't test any features for the first app. And, I just threw features at the problem. So launched the first app, we weren't making money, just said, okay, well, let's do more features, and thinking features would solve the problem. But didn't really ask a question of, what do people really want? And not just what I think is cool, but actually thinking, what do people want? So the wishful thinking of, to make R1 million a year or R1 million a month, I just need 1,000 people paying R1,000 a month. I mean, that's easy, right? But it's not that easy. R1,000 is a lot for a lot of people. For most people, for all people, in fact. So if you don't deliver enough value, where the perceived value is more than R1,000, people aren't going to pay. Wishful thinking in terms of funding, thinking it's going to be quick. You've got a cool idea, you just need to get a few investors. It's going to be easy. Wishful thinking with product launches. Wishful thinking of so many things. So the one is, I've got a lot less naivety, and that's what I mentioned, because you learn some hard lessons, valuable lessons. The second one, I'd say, is definitely in the line of thinking that things happen faster. So there's 2 sides. I'll combine my 2 and my 3. My second point is, I'm a really fast mover. Like, if I've got an idea, I'll be able to get it. Like, just give me some money, I'll be able to get it to you live in not a long period. The problem with moving really fast is sometimes you miss out on quality, which bites you later. Sometimes it forces you to take some shortcuts, which bites you later. So there's a few benefits of moving fast, because fail fast, fail forward. But on the other side, my third thing is moving too slow as well. So in certain areas, especially as our team grew and our processes grew and our consequences of doing things grew. Sometimes we take too long to develop something, and there's a few reasons behind that, but I think you really need to find the sweet spot between doing something fast and doing something not too fast in a way that you don't lose out on quality and you don't lose out on certain important things. But moving fast will also give you the ability to not overcomplicate things, not overpay for things, not overthinking things. So those are, there's so many, and it depends on what topic. If you ask me specifically fundraise or specifically product, I'd have different answers. But if I had to give it three in just general, those are the three.
Amazing. And then going into FinMeUp, so you decided to build community first. What made you do that? And could you walk us through the steps that you took from that idea to building community to then servicing that community?
Yeah. So I think one thing I realized very early on was brand is everything. A brand is the most expensive part, in my opinion, and connected to a brand is community. And in the financial industry, trust is everything, and how you get trust is through community. So even if we break it down smaller, a year ago we didn't know each other. If you saw an ad of me talking about we are financial planners, let me be your financial planner or a financial advisor, you most likely wouldn't do it because you see those ads every day. But if we've been on 3 coffees and you've seen some of my podcasts or videos, and I've seen some of yours, and we've played a paddle game together, we became friends, we became community. If I then tell you, well, look, we do financial planning, we can sort out your investments and insurance needs, do you want to chat about it? All of a sudden it's much more easier for you to say yes because you trust me more. And that's how I just view the community. And so how do we build trust at scale? And that was education. If you think about teachers or lecturers, whatever it is, it's the students build trust in the teacher if they really know what they're talking about. And one day, if I've got a science problem, which I never will because I hate sciences, but I know there's a teacher in high school that I'd go back to because I trust her. So for us, it was the education part on YouTube, on our app, on newsletters, on social media. Just put as much free education out there as possible. And if it's quality, it will scale itself. The algorithms will start picking it up. People will share it with their friends, etc. And that's what happened. So by the time we launched our second app, which was not just post MVP, we already had about 50,000 community members. And that's how we were able to get, I can't remember the exact stats, but we had close to 10,000 app users within the first month of launching the redeveloped app. And, we obviously not pivoted, but iterated. You can say what you want or call it what you want, but now where financial planning is our main business, it's much easier for us to convert clients at a very low cost per acquisition because we've got a bit of a following and many of those members trust us. And we've been sharing investment knowledge, financial knowledge, and we believe we know the industry well. So it's much easier for us. So it was part of a funnel. So for me, it was just always, building a brand, building a community for anything B2C specifically is super important because the sooner you start building the brand, building the community, the better, because it takes very long. It takes super long to build a community.
Definitely. And I 100% agree with adding value for free and building that trust. Something else that I had a question about was the financial landscape in South Africa. How difficult was it to become a financial service provider?
So we were very blessed in the sense of, so when I started FinMeUp, I never thought we'll be doing, financial planning and pet insurance and all of that. What happened was I launched it as financial education. Always knew I wanted to be a one-stop shop, whatever that meant, but I wanted to be a financial one-stop shop where we also service the product. So my beginning motto was from education to execution. The education part is simple to understand and the execution is products. I don't know how to do it, but it was part of the dream. So one of our first investors, a company called Zach Finance, ZIQ, they are entrepreneurs by nature, and they've also got a few businesses, and part of those businesses they've needed to get the necessary licenses, which is the category 1 and category 2 license at the FSCA. So, they invested, we started working with them, very good relationship, and, the one day I was like, why don't we just launch financial advisory? It's a key part of this, and let's launch it, see where it goes. And fortunately, they had the knowledge of that, and they had the necessary license. So we fell under their juristic representation, which you need to be 2 years under, and that's how we could start this, the entire servicing of that, and which started as an experiment, blew the lights out compared to all our other products and services. So that's why, now it's our main business. We were very fortunate with the right investors.
Okay. Also, what I'm gathering from that is find partners, find collaborative partners that can help you grow, and you can also help grow.
100%.
So my intention with the rest of the episode of the podcast is to help the average person with management and growing their finance. So the first step for me is changing your mindset around money. What would you define your specific mindset around money?
Money make money, hey? So to simplify it, I don't know if I came up with it or I heard it somewhere or read it somewhere, but I love the concept of viewing your money that you have as employees, like digital employees that just never stops, making money while you sleep. And that is essentially, if you're employing your money to work for you, you're going to get more money because they are really good employees if you invest them well. And for me, it was always, how can I make money while I sleep? To actually think lazy. How can I make money while I sleep? And the only way to really do that is, irrespective from starting your own business, because that can also happen, but it's passive income, and passive income is mostly investing. And if you invest in a company, whether it's a share, you can invest in Microsoft, and you've got the world's best management executives, the world's best AI developers, the world's best products, sticky products. You can invest in that business, and you own a part of that business. And those systems that they have work 24/7. They generate money 24/7. So if you invest in it, you can actually also get a part of that business as if it is your own business. And that's the same investing in so many other things. In property, it's a bit different, but the rental, if you don't have to work for that rental income. Same with, I'm not going to bring crypto into this conversation, but there's so many different assets. You just want to buy income generating assets, and sometimes it's capital growth and not income generative, but with investing your money, what works for you.
Definitely. Before we get into investing, how would you define or differentiate saving and investing?
So let's say you want to become wealthy. I don't want to use the word rich, because what is rich? But let's say you want to grow your net worth. There's two sides of that. There's two ways you become wealthy. The first side and the first step is you need to generate income. That could be from your own business, your side hustle, your salary, whatever that is. You need to get money into the bank account. That is the first step. Part of the first step is you want to save as much of that as possible. That's the budgeting. So it's like step 1.5. If you get in 100 Rand, you want to spend as little as possible. You want to spend 30, 40 Rand, because then you've got 60 Rand, which you can invest. And that's 60 Rand. In 1 year's time, it's 66 Rand with a 10% growth. So the more money you get into your bank account, the more money of that you save with, spending less, saving more, the more you can invest. The second part of growing wealth is to invest, to make that money grow for you. So if you just follow that cycle repeatedly, you're gonna grow wealth.
Okay, let's use a case study of a general employee who happens to be a professional, and they earn a salary every month. What should this person be doing with that salary?
It depends a lot. It's a case-by-case scenario. It's very difficult. We can generalize, and I'll generalize now. But it depends on your age. It depends on your lifestyle. It depends on what is the income. Because, if you earn, in today's terms with inflation, if you earn 20,000 Rand per month, you're not going to be able to invest a lot, because if you have to pay for your own rent, your own medical aid, food, drinks, whatever, petrol, if you see that 20,000 is gone. So it's very different to that person to it is someone earning 100,000 Rand a month, where your expenditure will be a bit more because of your lifestyle probably increased, but you will be able to save more, so you'll be able to invest more. Another thing is, it depends if you are 20 years old or whether you are 60 years old. The amount that you should invest, in percentage-wise, will probably remain the same, but the types of investment changes radically. Young people, I'm very for risk, because if you don't yet have a family that you need to sustain, if you don't have a bond you need to repay, all of that, your time of taking risks is not too long. So it's the best time to take risks. With regards to how much you should invest, if we put it in percentage wise, I'd say aim for 30% at least. I know that's quite high, but if you can maintain 30% of your income, for 20-30 years, you'll be very happy.
And is that without taking into consideration your savings portion? So you get your income, and then say the income is 30K per month. From that income, are you now saying that on average, or you would advise 30% to invest? What about the savings part of it for like a rainy day?
So I'd say you need to make a goal of minimum 30% investing, and it's quite a goal. I mean, on 30,000 Rand, what's that? That's like 30%
9K.
is 9K. So it's already quite a portion that you're investing. Where the saving element comes in, if that is your minimum that you want to invest per month, then anything you save on top of that, you can invest as well. So it just takes your 30% maybe to 40-45%. So you should see saving as part of investing. But just the more you save, the more you can invest, and it becomes part of the investing portion. For saving is important for emergency savings, if something were to happen. And that's why also some of your investments should be liquid, illiquid, whatever. But other than emergency fund, earning 3%, 4%, 5% in the bank versus what you can do diversifying your assets into better assets than cash, because cash is not the greatest assets. Cash flow is great, but cash as an investment is really poor.
Could you explain to us why cash is poor?
Yeah, okay, so cash flow is king, because you need cash flow to be able to do things, to be able to spend, to be able to invest, to be able to live. But cash is trash as an investment, in the sense of, if you look at inflation in South Africa has always been quite high, let's say 6%. If you put it in a money market, interest rates are high now. So, money market, fixed deposits, those yields are much better at the moment. But let's fast forward, another 2 years, and maybe interest rates are down 1.5% from where it is now. All of a sudden, your money market is generating less than inflation. Your fixed deposit maybe even as well. And fixed deposits are simple interest mostly. So the thing is, you want to beat inflation, because otherwise you're farming backwards. So if your cash investment, separating emergency savings, let's say you view it as an investment. If it's lower than inflation, you're farming backwards, because things are getting more expensive faster than your wealth is growing. That is why historically, ETFs, unit trust, good unit trust, stocks, you can even bring crypto into the equation, even property yields and their capital growth, they are supposed to exceed inflation. So financial advisors, asset allocators, your goal is to beat inflation as far as possible, and cash doesn't do that.
Got you. And in terms of budgeting, so this is something that I've also noticed that people need help with. What would you advise on effective budgeting?
Yeah, it's so tricky, because there's things that catches you off guard. For me it was last month. You get petrol that goes up. All of a sudden, that's now more than you budgeted for. You get your water, electricity bill, and I had a leak in my garden, and the water was running underground for an entire month. So you can imagine what that bill was. and all of a sudden your entire budget is just out of the window. But it is good to have a plan. So we always have dreams, but in order to achieve the dreams, you need goals, and in order to do the goals, you really need to do the SMART goals. So identify what they are: realistic, measurable, attainable, all of that. So if you have, there's a lot of people who work with budgets in spreadsheets. I'm not one of those people. I'm not really like a spreadsheet kind of guy, but it is really good to use spreadsheets. But in my mind, I have daily spend amount, because for me to say per month I'm going to spend this is more tricky than what I say, okay, this is per month, I'm going to divide it by 30 days, and on a daily basis I can just ask myself, okay, well, did I spend more or less than that? Because every day I'm like, okay, I actually saved more money, I'll be able to invest more, or I didn't save, I saved less than I was supposed to save, therefore tomorrow I should save a bit more. So I just break it down much more on a daily basis. Work out your monthly budget, divide that by 30 as a practical tip. Just evaluate that every day.
Yeah, that's a good tip. And you mentioned there emergencies happen, like the burst pipe. So how do you deal with that without compromising your long-term goals?
So there's a third part of building wealth. So the first part that we said was you need to get income from a salary or side hustle or whatever. Then you need to save as much as possible and invest. The second part is invest. The third part, which we don't really ever speak about, is protecting your wealth, and that is the insurance aspect. Obviously insurance, it's a grudge purchase. You wish you never use your insurance, but when the emergency strikes, you're glad you had insurance, and that is why I really believe in insurance in certain things like car insurance, home insurance. Life insurance for the people you care about. There's a few insurance that's really important. So for me, for example, emergency, at the end of last year, I was in a small car accident. I had insurance. It covered that. So I didn't have to pay, I don't know, it was like 20 or 30,000 Rand. I didn't have to pay that out of my pocket. Insurance covered it. So tick box, insurance covered me there. For home insurance, they didn't pay the full amount, but at least it assisted with fixing it, getting the plumber in, fixing it. So insurance is a vital part. But then also you need to keep in mind, insurance doesn't always cover everything, and didn't in my case. They didn't cover the water bill. I'm still in the process of applying for a rebate, but anyway. So you need to know that emergencies will happen, and that's where emergency savings come in. That is why it's critical to have an emergency savings account, because we never know what's in the future, and you just want that safety net for if something happens, you're good. And that was it in my case, because I don't want to invest less per month. I'd only want to invest more, and the emergency savings is there for rainy days.
Got you. And getting into investing, so someone at the beginning of the investment journey, what common mistakes do you notice that individuals make?
There's the biggest investing mistake in general. It's not just newbies. I still make the mistake, and that is making your emotions part of your investment decisions. Not even decisions, even after you've made the decision, when your emotions come into play. So, to give you a practical example, let's use Bitcoin, because Bitcoin is mostly demand supply. The demand is driven by emotion, essentially. So you can have a plan. Let's say there's two types of people. The one person says, they understand the fundamentals of it and they back this for the long term. And then there's the person who thinks a bit more short term, like a trader, where, I studied the history of Bitcoin and the cycles, and, part of cycles is human emotions. And my plan is that I'm buying now, I'm selling it next year, April. This is my reasons why I'm going to start scaling it down by then. So you've got this entire plan beforehand, and then Bitcoin rises 10%, and you feel like a genius. It's just going to go up higher, and you buy more, and then all of a sudden, because volatility, it drops 20%, and then you think, I knew. Then you see all the headlines on Twitter or whatever where it says Bitcoin is dead, and now I think, oh crap, okay, this was the wrong mistake. I'm selling. And then it's going back up, and then you buy again at the top, sell at the bottom. And it's the same with shares, the same with all assets, is there's reason we make plans. It's because we think throughout, what could go wrong, what could go right, separate the emotions, look at all the detail, make a plan. It's the ability to be able to stick to that plan, whether it's your budgets, your, investing 30% per month, whatever it is. You make a plan out of emotion, but as soon as volatility kicks in or something doesn't go according to plan, or even if you planned for it, we tend to sell too soon or buy too late, and vice versa. So it's important to stick to a plan and not let emotions get the better of you.
And for someone that's now starting, would you advise firstly educating yourself by watching your content online, and then, for example, investing on an app, or if possible, speak to someone as a professional? What would you advise that person that's starting in the investment journey?
So I think a mix of three. You mentioned the one is educating yourself, the second one is just starting by yourself, and the third one is talking to a professional. So educating yourself, super important. You need to never stop doing that. Even if when you are expert, you're not an expert. So it's always never stop learning. The second part of just starting, I'd actually say just do that. Start today, open an account. Even if you invest 50 Rand or 25 Rand, you've got skin in the game. So what I did was, when I wanted to research specific companies that I didn't really know yet on the JSE or the Nasdaq, I just buy 100 Rand worth of those shares. If it were to crash, I'm fine. But as soon as you even just have a little bit skin in the game, you've got that extra incentive to really understand what the company's doing. How investing works, what causes the stock to go up or down, all of that. So just start, even if it's very small, but it's a nice incentive if you have some skin in the game. And the third part is speaking to a professional, and that is a mentor. So for me, mentorship is, you need that in all facets of life. Marriage, business, health, you name it. Mentorship is everything. And that's why actually at FinMeUp, we don't call ourselves financial advisors. Yes, we're financial advisors, financial planners, but we call ourselves financial companions. Just for the definition for that is a partner, a mentor, a friend. And that's what we want to be. And hopefully in all industry, doesn't matter what industry you're in, there's a professional helping you out, educating you, mentoring you, but not just as a professional service, but actually as a partner service. And it usually helps if your mentor has skin in the game. I'm very passionate about mentorship, but what I've seen in my own business, where I'm involved in other businesses, everything is you get mentors at the base level who they've learned a lot and they just want to give back, and they get a kick out of it, or they just want to help the person. On top of that is mentors who feel like it's their purpose to mentor, and then you get the mentors on top who gives everything, who's a mix between the first two, but also a mentor who has skin in the game. I had people mentoring me, but as soon as they got skin in the game, and for some I even just gave equity, not for funding, not anything, part of sweat equity, because if they've got the incentive to make your thing work, and there's a financial benefit for them as well, it really helps. And that's why, for us, our model is we take a small percentage of your total assets. So if we grow your assets, we grow our revenue. So that's just our model of, and that's the traditional model. But I mean, if you can apply that to different industries.
You spoke about diversification early on. What would you advise on diversifying for an early stage investor?
I think there's a lot of traditional asset allocators who would want to slap me right now, but I'm a firm believer in not over diversifying. Obviously, the more you diversify, the less risk you have. So if you've got a very low risk appetite, by all means diversify as far as possible in various assets, various geographic locations, various companies, whatever. For me, I'm young, and I really research that which I invest in. I really understand what I invest in. So I'm a big believer in high conviction bets. So what I'd recommend versus what I do myself is a bit different. What I do myself is, if we look at liquid assets, so irrespective from my house or my car, like just liquid investments, I barely ever have more than 4 or 5 investments in my entire portfolio. And sometimes I'll even have 80, 90% of my investments in one asset, and that's what I would not recommend. But I spend a few hours a day researching those assets, and I'm fine with the volatility it brings. What I would recommend that is the sweet spot is 7 to 12 investments, just because it's not too much to keep track of. If you've got 50 investments, let's call it 50 shares, how on earth are you going to keep track with all 50 of those, understand the 50 of those, if the fundamentals change of the 50 of those? Like, how are you going to keep track of that? Where if you've got 7 to 12 concentrated bets that you make it a priority to really understand, to track, to follow, it's much easier. But that's for people who want to research themselves. For majority of people who don't want to use financial advisors, who want to do it themselves, but they don't want to do the research, I'd say just look at ETFs. It's over the long term, ETFs outperform probably most fund managers, just because of the mechanics of it. And an ETF is a bunch of stocks into one investment, so there is diversification in that itself. And then you can also look at, you can look at the JSE, the All Share ETF. You can look at the MSCI World ETF, which is everything in the world. You can look at Emerging Markets ETF. You can look at the S&P 500 ETF. So then you get diversification into various companies, but also diversification into various countries.
Okay, that's really valuable. I also want to ask a question around, we as humans, in my opinion, spend on what we value. So how do we have a rich lifestyle now and enjoy what we're making while still building for the future? How do you find that sweet spot?
Yeah, so for me, it's, money is not everything. Money is a tool to do a lot of things. And part of that, the one tool it is to enjoy your life. Go on holidays, take your wife out to a nice dinner, whatever it is. And for me, it's part of my monthly budget. I put money away into a separate money market account, which is very liquid, into I call it my vakansie savings, which is holiday savings. And I've got different goals. Sometimes it will be for an Airbnb weekend away. Sometimes it would be for a big holiday planning, next year. Sometimes it's not even part of that savings, and I just feel, I want to treat my wife because we should treat each other. I'm going to take her tonight to a nice restaurant, and I'm not going to think about the finances. And, that's fine. For me, it's not just, if you're going to be in such a bad mental space because you want to invest 70% of your income and, long-term wealth is everything. That's not for me. It doesn't help, you've got so much money in 40 years time, but you didn't enjoy the journey. So there's definitely a sweet spot, and I do think you need to treat yourself. You need to treat your loved ones. It's very important, not only as to after your finances, but for mental health and even to make clear decisions about finances and business. Is if you're at a good headspace, you'll make better decisions.
Definitely, 100% agree. I think that once more it starts with understanding what you value.
100%.
Another major topic is debt. And a third of South Africans are currently in debt. What advice do you have for individuals or what practical steps can they take to get themselves out of debt?
Yeah. So for me, I've got debt on my own. Okay. So I don't currently have any personal debt because I really think personal loans stay as far away as possible, because those things can eat you. So when you have personal debt, I'd say just pay it off as soon as possible. Make that your priority before investing even. Stop the bleeding. You get good debt and you get bad debt, and a home loan can be seen as good debt, because essentially the debt that you pay back, it's tax-free, it's at a good interest rate, whatever. So for me, currently I'm prioritizing my investments into a bit of crypto, a bit of equities, a bit of unit trust, a bit of tax-free savings, but also my home loan. A big part is my home loan because, the interest rates are so high. Around 11. So if you pay off your home loan now, you're essentially paying for around 11.5% growth, depending on your interest rate, 11% growth in the asset that's basically tax-free, and you're paying off an asset that is actually yours. So for me at the moment, while interest rates also high, I really view it as a great decision to pay off your debt, because the interest that just keeps on climbing, the payback periods, all of that plays a role on your long-term wealth. Because if you're debt-free and you can just prioritize investing into assets that grow your wealth, that's ideal. But I know there's a lot of smart people who also prefer to have a lot of debt. I'm not one of them. Just for my personal consciousness, I want to sleep in the evenings knowing I don't have debt, but I still do. So I want to pay that off as fast as possible, but I don't put all my money just in that. I also put it into investments.
Do you see having a personal home as an asset, the one that you own and also live in?
I do, 100%. Once again, smart people will differentiate from me. But for me, I see it as one, it forces you to invest per month because you need to pay that monthly debit order. So that is every month the debit order goes off, it's an investment. The second part is it's an investment in your lifestyle. For me, the home I live in, it's a massive investment lifestyle because, I feel more free. When I do something in the house, in the garden, it lifts up the value, even if it's a little bit. So it's a massive lifestyle investment as well for mental health. And the third one is it is an actual asset. Property, bricks don't get cheaper. Property in the right area doesn't get cheaper. So it is an actual asset. It's not a liability. A car can be seen as an asset in the sense that, it gets you to where you need to be if you need to drive to a meeting, but it's actually a liability. It depreciates. It doesn't really grow in value unless you've got these collector cars. I'm generalizing now, but an asset, a property, historically, most properties tend to go up in value. So yes, it's an asset in my opinion.
In terms of opportunities, in your opinion, are there any opportunities that people overlook or don't pay attention to for some reason, investment-wise?
100%. But I definitely think it's a preference thing and a passion thing. Like some of my friends, one friend, he just wants to go farm. He doesn't care about the stock market or anything like that, and that's why he trusts the professionals. But I've got other friends who love watching the Bitcoin stock market every day, and it depends on passion. So I'm not going to force everybody to look at investment opportunities because it's not for everyone. People have different callings and purposes. For example, my wife, she doesn't care about investing or the stock market. She obviously has to listen to me because sometimes I talk about it, but her passion is health and wellness and fitness, and that's fine. People have different purposes, so it's not for everyone. If it's not for you, it's still important that you invest. That's why then you need to get a professional, put in a debit order, force yourself to make that investment. If it is for you, there's so many investments that I've trusted my gut and I've made a lot of money, but I've also trusted my gut and lost money. That's where the diversification aspect comes in. Who knows what's going to happen in a week's time, and that's why I wouldn't recommend my concentrated bets. One of my concentrated bets a few years back was Steinhoff, and I absolutely lost all my money in that. So and there wasn't something I could spot. Everything looked brilliant. Every year their asset value was growing, their revenues were growing, but fraud. I couldn't have seen that coming. And
you and many people.
Yeah, and you can't blame yourself for that. But, for me, once again, it depends on your risk appetite. If you've got a low risk appetite, you really just want to preserve your capital and grow it steadily, then it's perfect. Go low risk. Don't look for the high risk stuff. And if you've got a high risk opportunity, take a few bets, educated bets where you've done your research, where you've made the plan and not let the emotions get in the way. But there's basically 7 different risk profiles of people, and everyone falls in those risk profiles, and it goes from very low risk to very high risk, and it depends on what you are, where you need to invest. So it's very difficult to generalize, but yeah.
Next steps for FinMeUp. What's coming in the pipeline?
So we are launching something called FinMeUp very soon, which is the risk profile I just spoke about. So there's various animals, and depending on various factors, you are one of those animals, and you can generalize by how you should invest accordingly to that animal. So we're launching that very soon. We also have a platform now where people can do goal-based investing. So you create a goal. It can be travel the world, retirement, grow your wealth, education, whatever. So let's say you travel the world. You say you want to travel the world in 4 years' time. You say you can invest this amount per month. This is your risk profile. Everything is connected. Then it helps you according to that goal to invest towards that goal, so that you can essentially travel the world in 4 years' time. And it even tells you what kind of traveling you can do, whether you can do a ski holiday or whatever. So it's quite cool. We're also in the process of getting more and more financial advisors, or in our terms, financial companions. If the financial advisor is someone we believe has the same values, same principles, the same view of finances, we onboard them. They're part of our structures. We're also on the lookout for a few potential acquisition opportunities if it makes sense, but more to follow on that. So there's and also lots of free education that we're going to put out on social media, on our YouTube channel. So there's a lot of things happening at FinMeUp. As we're still a startup, as startups go, I can't tell exactly where we're going to be in 12 months, but I just know we're going to give it our all to be really good financial companions for South Africans, and to grow a sustainable business out of that.
What would you say is your overall goal? That's the first question. And the second and last question would be, is there a place that you think you are aiming towards? And when you hit that place, then what?
There is. So we've, for me, I want to be a one-stop shop. I want FinMeUp to be a one-stop shop, to really be a companion. Because to be a companion, we need to educate, we need to mentor, and we need to provide the correct and the best products out there for everything financial. So that is the most important things. We can't be everything, but the most important things we're focusing on is investment solutions, short-term insurance, long-term insurance. And for the insurance, we partner with companies, the investments. That's what we take on head on, because that is our specialty that we believe we find the most passion in. And we've got a 5-year plan. The next 3 years is to really grow the financial companion base, the advisors itself, our client base. And then from year 3 to 5, we've got a certain amount of assets under advice that we want to reach, for us to make it feasible, possible to launch the products. The products will be where we actually manage the funds ourselves. So currently we are the middleman between asset managers and our clients, and we make sure that our clients are invested according to their risk profiles, according to their goals, into the best possible products for them. But in the future, it would be great if we can offer the product itself where we also manage the funds, because that is part of our passion. But there's a lot of bricks that need to be laid out first. There's a long-term journey within FinMeUp. There's a long-term journey within my personal life, and I can't tell you where we will be, but it's very exciting.
Thank you, Higgo. This was amazing. You gave so much value here, and I just appreciate your time and also what you're doing to create this financial education for all in South Africa and also beyond. So thank you.
Thanks for having me, and love what you're doing.
Cool. Thank you.